Talk about nominal negative interest rates.
Sure.
Let me bring in former Bundesbank president and current chairman of UBS, Axel Weber. He's in Washington today. Axel, good to see you. Thanks so much for joining us.
Good to hear you, Maria, and good to hear Larry talk.
Hi, Axel.
Good morning to you. Morning, Larry.
Two of the greatest minds in business with me right now, so I want to get both of your takes on the risks in the market. Axel, UBS obviously has been on a fantastic strategy of asset management, wealth management, really, for the long term. So I want to get into the UBS strategy in a moment. But what's your take in terms of what we're talking about here, the issues around liquidities? Does this worry you as much as what we're hearing from other executives out there in terms of the lack of liquidity in fixed income markets, Axel?
Lack of liquidity always becomes relevant when there is a stress situation, and we've seen that last year. So we all have liquidity management that is prudent, that is long-term oriented, but the problem is when the tide turns and when there is an event, then liquidity tends to be scarce, and so you need a much more robust and a much more conservative liquidity management today. And we've seen that in the last financial crisis. The first signs of problems always show up in liquidity. Solvency is an issue that kicks in later when things happen to happen for a long time, but liquidity is key. Larry, do you see that?
Well, I generally always agree with Axel. We actually, we always find ways to agree with each other. I'm worried too, but I'm tired of hearing people tell me they're worried.
What do you do about it?
Yeah, what do you do about it? And more importantly, the regulators should not be surprised at this. They've changed the business model of banks. In the United States, we have the Volcker rule that inhibits banks to have positions for principal reasons. We are seeing a slow evolution of the markets moving to exchanges, which I think is a mistake. We should accelerate that. And so we, as the largest investor in the world, of course we're worried about this, and we believe the policy of moving more products to exchanges will ameliorate some of the liquidity risks. That Axel was entirely right. But this should not be a surprise. This should have been understood as regulators changed the role of banks. When regulators asked banks not to have positions and they raised capital standards, this should have been understood.
Right.
We should have been working on this for 3 to 4 years to be prepared for this, and we're just sitting around talking, and regulators and admonishing the private sector about this. We need to be working with the regulators on a worldwide basis to fix this, and we need to do it now.
Before we let you go, Larry, I want to ask both of you about nominal negative interest rates, because this is another risk, right, Axel? I mean, we just looked at the 10-year Bund. We're looking at the 10-year even in the U.S. Even at a time when people think the Federal Reserve is going to raise rates, you're actually seeing rates move lower. To what do you attribute this decline, first, Larry, to you, in terms of nominal negative rates?
Well, the ECB is aggressively buying the bonds since they started quantitative easing. There are some worries that we are in a disinflationary environment, and maybe the negative rates are telling us something. My biggest worry about negative rates, it's mostly regulatory and central bank behavior that's creating it, and it is harming long-term savers. It's harming every insurance company. I talk to the insurance companies, as Axel does, in Switzerland and Germany. They cannot offer new insurance products with negative rates anymore. So negative rates may be good for the financing of debtors. It's terrible for long-term savers, retirement, pension plans, and insurance companies.
Axel, to what do you attribute these moves?
Well, look, at Switzerland, 16 years out, the Treasury curve has been pressed into negative territory. Swiss pension funds, Swiss insurance companies find it very hard, in particular when they have defined benefit schemes, which are still dominant in Europe. So this is creating an environment where we are actually in a world that's upside down. And I think the longer this lasts, the more dangerous it gets. QE can fix some problems, and Larry's right. Central bank's action has been in charge of pressing yields down. But I would add there are major global forces that are deflationary. So take, for example, the emergence of China.
Stay right there. Stay right there, Axel. Larry Fink, good to have you on the show today. Thank you so much.
Axel, have a good one.
We'll be right back.